London, 1933. Two men sit in the same bank, same building, same marble floors, same mahogany counters. The first man is a factory owner. He's been depositing his wages into this bank for 11 years, every Friday, every single week. He has never missed a payment. He has never overdrawn. On paper, he has $4,000 sitting in that vault. The second man has nothing. No job, no collateral, no history with this bank whatsoever. But the second man walks out with a loan for $6,000. And the factory owner? He walks in on a Tuesday morning to withdraw $200, his own money, and is told the funds are temporarily unavailable. His money, his deposits. 11 years of trust, gone, not stolen, not misplaced, just lent out to someone else. Here's the question nobody asks in school. If the money in your account is yours, why can't you always take it out? We are taught one thing from childhood. You earn money. You save money. The bank keeps it safe. Simple, reliable, reassuring. But that story has a problem. It is almost entirely fiction. The moment you deposit money into a bank, you are no longer the owner of that money. Legally, formally, on paper, you become an unsecured creditor. You have given the bank a loan. And they owe you that amount back, eventually, theoretically, under the right conditions. The money itself, it's gone, deployed, multiplied. This isn't a conspiracy. It's written into banking law in virtually every country on earth. Most people never read it. Most people never will. But here's the part that makes it even more interesting. The bank doesn't just hold your money. It creates new money using yours. And the story of how that system was born is one of the most important stories never told in schools. Part 1, the goldsmith's secret. Before banks as we know them, there were goldsmiths. You'd bring them your gold, they'd give you a paper receipt. A note that said, this person has X amount of gold stored with us. Simple, safe, honest. But goldsmiths noticed something. People rarely came back for the gold itself. They just traded the receipts. So the goldsmith had a vault full of gold that nobody was collecting. And a devious thought entered his mind. What if I write more receipts than I actually have gold? Who would ever know? So he did. He lent out receipts with interest for gold that didn't exist. And for decades, it worked perfectly. As long as not too many people came for their gold at once, the illusion held. This is the origin of modern banking. This is what economists call fractional reserve banking. The bank holds a fraction of what you deposit. The rest, it lends out, reinvested, multiplied. This wasn't illegal. It became the model by 1694. The Bank of England was founded on this exact principle, formally, officially, with a royal charter. The goldsmith's trick had become the law of the land. This is the first law. The bank never holds all of your money. Part 2, the man who broke Argentina. Her name was Lucia. She was 47, a school teacher. She had spent 22 years saving every spare peso she could. The plan was simple. Retire at 60, live modestly, never be a burden. On a Sunday afternoon in December, she heard something on the radio. The Argentine government had just announced El Corralito, the freeze. Overnight, withdrawals from bank accounts were capped at $250 per week. Lucia went to her bank on Monday morning. There was a line 3 blocks long. Police in riot gear stood at the entrance. Her $42,000 in savings, technically still there, legally still hers, but physically completely unreachable. Within weeks, Argentina defaulted on $132 billion in debt. The peso collapsed. When the freeze eventually lifted, the exchange rate had been forcibly changed. Her dollar savings had been converted to pesos at a fraction of their value. She didn't lose her money to theft. She lost it to a policy decision made in a conference room by people she had never met. This is the part nobody tells you. Your money is not just subject to the bank's decisions. It is subject to the government's decisions, the central bank's decisions, the IMF's decisions, the decisions of institutions operating on a scale completely invisible to you. The freeze in Argentina wasn't unique. Cyprus, do we need traced? The government seized up to 47.5% of large deposits to fund a bailout. Iceland, 2008, capital controls froze international accounts for years. The United States, 1933, Franklin Roosevelt made it illegal for citizens to own gold. If you had gold coins, you were required by executive order to hand them to the Federal Reserve in exchange for paper dollars at a fixed price. One executive order, one morning. Your gold now theirs. This is the second law. Your money exists within a system that can redefine the rules at any time. Part 3, the multiplication machine. Let's talk about something concrete. You deposit $1,000 into your bank. In most Western banking systems, the bank is required to hold a reserve, a fraction of that deposit. In the United States before 2020, this was 10%. Today, it's effectively zero for most banks. So your $1,000 gets lent out. Let's say $900 of it goes to someone as a loan. That borrower deposits their $900 into their bank. That bank lends out $810. That person deposits $810 into another bank, which lends out $729, which gets deposited, which gets lent. which gets lent again. Your original $1,000 through this chain can theoretically generate up to $10,000 in total deposits across the banking system. This is called the money multiplier effect. It is not a secret. It's in every university economics textbook. But there's a difference between reading about something in a textbook and truly understanding what it means. It means the number in your bank account is not backed by actual currency sitting in a vault. It is backed by trust, by the belief that the system holds, by the confidence of millions of people, simultaneously not trying to withdraw their money. The moment that confidence breaks, even a little, the system shakes. This is why bank runs are so catastrophic. It's not that the money disappears, it's that the money was never fully there in the first place. The magician can only perform the trick if the audience stays in their seats. But here's the part that changes everything. We've been talking about banks holding your money, or lending your money, or losing your money. But there's a deeper question, one that central banks and finance ministries would prefer you didn't spend too long thinking about. What is money, actually? Not philosophically, practically, legally. In 1971, Richard Nixon made a phone call, and then he made a speech. And in that speech, he severed the last link between the US dollar and gold. Before that moment, known as the Nixon Shock, every dollar in circulation was technically backed by a physical reserve of gold stored at Fort Knox. You couldn't just print dollars without having the gold to justify them. After that moment, the dollar became a fiat currency. Fiat, from the Latin, let it be done. Money now existed purely because the government said it existed. Because the collective agreed it existed. Because the system reinforced that it existed. The dollar, and by extension every currency linked to the dollar, which is almost every currency on earth, is backed by nothing but institutional credibility. This is not a fringe theory. This is the official position of central banks worldwide. When the Federal Reserve wants to stimulate the economy, it doesn't go to a vault and count gold bars. It types a number into a computer. Hundreds of billions of dollars created instantaneously from nothing. In 2020 alone, the US Federal Reserve created more money than in its entire 100-year history prior. Which brings us to the third law, the one that ties everything together. This is the third law. Money isn't a store of value. It's a measure of trust. And trust can be manufactured. Part 4, the quiet theft. His name was Heinrich, a retired German military officer. Disciplined, meticulous, he had saved his entire career. By 1920, he had 200,000 marks in the bank. A small fortune, enough to retire comfortably for life. By 1923, that same amount couldn't buy a single loaf of bread because the German government, facing catastrophic war debt after World War I, had done the only thing it thought it could do. Print more money. More and more. Faster and faster. At the peak of Weimar hyperinflation, prices were doubling every 2 days. A wheelbarrow full of money to buy groceries. Workers demanding to be paid twice a day so their wages wouldn't lose value between morning and afternoon. Heinrich's 200,000 marks, every pfennig saved over a lifetime of service, was worth less than the paper it was printed on. This wasn't Germany being unusual. Zimbabwe, 2008, inflation hit 89.76 trillion %. The government eventually abandoned its own currency. Venezuela, 2018, inflation exceeded 1 million %. People weighed cash instead of counting it. Hungary, 1946, holds the world record. Prices were doubling every 15 hours. Every single time, the mechanism was identical. A government in crisis, a central bank under political pressure, a printing press running day and night. And ordinary people, savers, workers, pensioners, holding the bag. The money didn't disappear, it was diluted. Your slice of the pie stayed the same size. The pie just kept getting bigger and bigger until your slice was almost invisible. This is the fourth law. Inflation is a tax. One that requires no vote, no debate, and no signature from the person being taxed. Part 5. Who actually benefits? Zoom out. Because everything we've covered, fractional reserve banking, fiat currency, the money multiplier, inflation, all of it exists within a larger architecture. And that architecture has winners and losers built into its very design. When the Federal Reserve creates new money and lends it to commercial banks at low interest rates. Who benefits first? Banks, the institutions. The large investors who can immediately deploy that capital into assets, real estate, stocks, commodities. By the time that money filters down to the average worker in the form of slightly higher wages or lower loan rates, the assets have already appreciated. The people who had assets before the money was created now have more. The people who had only savings, they have less purchasing power. Economists call this the Cantillon effect, named after Richard Cantillon, an Irish-French economist who described it in the 1700s. The people closest to the money printer get rich first. The people furthest from it pay the price. This isn't ideology. It's geometry. It's the shape of the system. And the system was not designed by accident. Let's bring it all together. The goldsmith in Amsterdam, the factory worker in London, Lucia in Buenos Aires, Heinrich in Weimar, Germany. Each of them was operating under a single belief. My money is mine. And each of them, at the moment of crisis, discovered the same truth. The money in your account is an entry in a database. A number maintained by an institution operating under rules you did not write. Rules that can be changed quietly, legally, with no vote cast in your name. This is not an argument for nihilism. This is not a call to bury gold in your backyard. It is an argument for clarity. Because the most dangerous financial position a person can be in is not poverty. It is unconscious trust. Trusting a system without understanding its mechanics. Saving diligently without understanding what you're actually saving. Believing in the permanence of numbers while living inside a world of fluid, manufactured value. Every financial crisis in the last 200 years, without exception, followed the same pattern: complexity, opacity, complacency. People assumed the rules were fixed. Institutions assumed their models were right. Governments assumed the confidence would hold. And then one Tuesday morning, someone went to withdraw their money, and the line was 3 blocks long. The truth is not that banks are evil. The truth is far more unsettling. The system works, right up until the moment it doesn't. The people who navigate those moments best are never the ones with the most money. They're the ones who understood, clearly early, and without illusion, what money actually is. A promise, contingent, institutional, fragile, powerful when trusted, worthless when not. Money is humanity's most sophisticated collective fiction. And like all fiction, it only holds power over those who believe in it without questioning the author. The question isn't whether the system is broken. The question is whether you understand the system well enough to move within it consciously. Most people spend their lives working inside a machine they never studied, obeying rules they never read, trusting institutions they never examined. That is a choice. Passive, invisible, but still a choice. You now know something different. What you do with it, that part is entirely yours. If this changed the way you see the world, even slightly, subscribe. Because we don't just study history here. We perform autopsies.